Community Fund. Thank you so much for joining us this morning or afternoon, depending on where you are, for our Nonprofit Strategic Budgeting and Scenario Planning webinar with our friends over at the Nonprofit Finance Fund. Thank you so much for introducing yourselves in the chat with your name and organization. And in honor of National Pie Day, which was yesterday for March 14th, we did ask folks to share what is your favorite pie. So mine is a fresh fruit peach pie. So again, it's happy Ides of March, but also Pie Hangover Day. Just some fun RSVP facts before we get started. We do have a lot of people who are interested in this topic, with 45 staff, board members, and volunteers from 34 different Asian American and Pacific Islanders serving nonprofits joining us. And about 2/3 of you directly manage your organization's finances, which means that we also have some newbies in the room, and we welcome you to learn more about your organization's finances. On average, the full-time equivalent is nine full-time FTE at your organizations, with about half of you with less than 5 FTE. So we do have some smaller organizations that are in the room, and your annual budget is about $1.5 million. And most of you, about 84%, have no previous experience working with the Nonprofit Finance Fund. So welcome and thank you so much for joining us. Again, my name is Christine Lee with the Asian Pacific Community Fund. Just some tech housekeeping. This is a Zoom meeting rather than a webinar, which means that if optional, we can see you on your video. But so feel free to turn it on if you are so inclined, but we ask that you do stay muted for the majority of the presentation, but there will be very interactive portions. So we do invite you to participate as much as possible, either via the chat, raising your hand, or when the time comes for Q&A and discussion, you can also raise your hand and unmute yourself when called upon. This is brought to you by the API Nonprofit Capacity Building Program of the Asian Pacific Community Fund, in the belief that for us as a grant maker, focusing on the needs and the nonprofits serving our Asian American and Pacific Islander communities throughout Southern California, that our communities are best served by organizations that speak our language and know our cultures and are able to provide culturally responsive programs and services to our community, most especially those who have been underserved. And I think that's really been apparent, most especially during this pandemic and with the rise of anti-Asian violence. So we really applaud you for being a part of these organizations and for fighting the good fight. And we just want to be able to provide these kinds of capacity building, technical assistance workshops with partners like the Nonprofit Finance Fund to ensure that you have the resources and the capacity and the infrastructure to continue to do what you do best for our community. We are very pleased to work with the Nonprofit Finance Fund. This partnership has extended since I believe about 2017, and we've done some of these workshops back in the day we used to do in person. But we are very happy to bring them back after several years, because we know that there's some organizations, like we saw in the registration, that have never worked with NFF before and don't know about the amazing resources that are available through this organization, and how they can strengthen your capacity and to really take a good look at your finances, to be able to tell your funders, to be able to tell your partners, your community stakeholders, your financial story, and how to really ensure that you have what you need to to sustain your organizations and to even thrive. So I'm very pleased to introduce our speakers. First of all, we have Sherr, who is the Director of Client Services at NFF. She's the one that's waving, and she's been with NFF since 2013, supporting funders and nonprofit leaders to navigate change and reframe challenges. And she has previous project management and development experience in the international development space. She has her MPA from Columbia University School of International and Public Affairs, as well as a bachelor's in religion from Middlebury College. So thank you so much for joining us, Sherr. And we also have Jackie Doherty, who is the manager of client services at NFF. And previous to that, she was a senior manager of institutional giving at Sundance Institute in Los Angeles, as well as the director of development at Finger Lakes Reuse in Ithaca and the Willie Mae Rock Camp for Girls in Brooklyn. She has a bachelor's in communications from Northwestern University, as well as an MA in developmental psychology from Columbia University Teachers College. So I'm very happy to turn this over to them. Just a quick housekeeping, I forgot to mention, this is being recorded and the slides will be shared at the end. We anticipate running to about 11:45, but there will be some extra time for additional questions and answers, an office hours, as as we like to call it for the Zoom webinar. So if you're able to stay on beyond 11:45, we invite you to stay. So I will turn it back over to Sherr and Jackie with the NFF team. Thank you so much.
Thank you, Christine. And I just wanted to first and foremost say that we also have a third member of our team, Emma. If you could just wave, Emma. She will be instrumental today in helping us facilitate this webinar. We are actually trying something new, which we're going to talk a little bit more about why it's new and how it's new in delivering this particular format. So Emma is very integral to kind of supporting us from a tech perspective. Although she's silent, she's very much going to be there. So just wanted to say that we have another member there in the wings, if you will, and supporting us. So let me just fix my screen here so that I can begin to share the information I have today. And if you don't mind, just hold on for a second. All right. So first and foremost, let me check. Can you nod your head if you can see my screen, just so I can make sure I'm sharing the right thing? Great.
Sure, it's showing the presentation view. So if you switch it, it might get a little bigger for everyone to see.
Thank you so much.
Yeah.
Yeah, that's why I asked, because I have shared many things that should not be shared. And let me try again and see if I can do this right this time. And this time I'm just going to share it. Does that work?
Much bigger.
Okay. Okay. I'll share the other part. Okay. All right. So given the fact that there are about roughly 84% of you who have never heard of us before, first and foremost, I should step back and say Jackie and I and Emma are incredibly thrilled to be speaking to all of you. Christine was able to share with us the registration list, and as it was growing and we were seeing names come in of organizations and different positions and more facts and figures about who you guys are showing up, we were getting more and more excited to meet you all. As someone who identifies as Chinese American, I will say that after having worked at NFF for close to 9 years, we have actually never engaged with the AAPI community in a very intentional way. I know that Annie Chang, many of you may have heard her name. She has been engaging in partnership with APCF with the communities, particularly those based in the LA area. But as a national strategy, we really haven't been very conscious or intentional, let's say, about really focusing on the needs of specific communities, in particular the AAPI community. So I am thrilled to be able to present and facilitate this discussion among you all. So who are we, right? Nonprofit Finance Fund, or NFF. Our mission is to support community-centered organizations like yourselves that are led by and serving people of color, and really help them access capital, help them access investment and know-how that they need to realize their vision, their mission, the opportunities that lay before them. NFF was founded over 40 years ago, originally as a lender to nonprofit. We are a community development financial institution, CDFI, which is another fancy way of saying we're designated to take money from secondary sources like banks and treasury and lend back to nonprofits. And I share that with you because, our history of lending, you can imagine that as we were thinking through how best to, lend to people, what is risk, what are the profiles of folks that will be able to pay back the loans, if you will, we developed a nuanced and a very important point of view about what financial sustainability looks like. And so, I will say that where I sit in the organization, client services, originally was called, or another way of thinking about it is consulting, was born out of the lending services because we developed and started to deepen our knowledge around what it meant to be sustainable, what it meant to thrive, And so these are some of the things that were some of the concepts here that we're going to share today. The underpinnings of the concepts really came from really thinking critically about working with leaders, thinking through what viability means, what sustainability means for the nonprofit business model. And over time, in the past, most recently since 2016, we have done a lot of introspection, right? And thinking about how we can better serve those that are often missing from the table, right? That do important work, that hold the trust in a lot of communities, and how can we better serve those that maybe don't, that are worthy, but maybe don't show up at all the quote unquote right tables. And so we have in recent years really started to orient ourselves towards a new way of working so that we can better engage with usually they tend to be smaller, but not always, but communities, community-centered organizations, organizations that really work in by allowing and enabling community to lead. And they are often led by people of color, serving people of color. And so today, you know, I'm presenting this to you only to say that after a lot of introspection, we recognize and acknowledge that, you know, we are part of institutions that have been traditionally white-led and white-serving. Financial institutions, generally speaking, have a long road to travel when we're thinking about racial equity and equity and inclusivity just generally and broadly, right? So just to say upfront that we acknowledge our role in perhaps perpetuating some of the systemic imbalances that have existed. And at the same time, consciousness is very powerful. And just to acknowledge the fact that we're aware and we're working towards adjusting our business model in the way that we're working in a way that will then be able to, you know, result in a fair society for all. All of that is to come back to say, you know, we are here to serve organizations like those who have showed up today, and we're very excited to do that. Christine had shared some stats about who is in the room, and we looked at that too. So I want to do first and foremost, you know, Christine had shared that most of us are based in California, but there are some that perhaps are beyond the California borders. And I just wanted to take a look at everyone here. And if you could either, you know, share, if you're in California, if you can wave your hand, or if you can, you know, give me a reaction or a thumbs up, and just to see who is here from California. That's great. Not surprising, but I'd love to just kind of get a sense. On Zoom, I really want to get a feeling of where people are dialing in from. So this is really, really great for me. Wonderful. Thank you, Sunshine. Now, how about those that are beyond the California borders? I'd love to see, and just to get a sense of who is from outside. If you want to share, Karen, hello, where are you coming from? You can share in the chat. You don't need to come off mute either, just so that I get a sense of.
I'm in LA, sorry, I was trying to take the hand.
Yeah, it's not fast enough sometimes. Wonderful. How many are from outside of California? Honolulu. Ooh, I want to be where you are. Wonderful. Well, welcome. You know, welcome everybody coming from, you know, from across the United States. It's really great to see a good representation. I myself, I'm actually based outside of New York City. So I'm operating out of the East Coast time zone here. So who else is in the room today, right? So we wanted to share a couple of interesting stats, or stats that were interesting of us. When we start to put together conversations, discussions, content, we want to know what is most important to those in the room. And two of the areas that we look at is, you know, the size of the organization, in the sense of it gives us some sense of perhaps some of the questions that you may be asking yourself as a leader of a particular organization. You know, we've noticed that certain organizations, depending on size, could deal with different types of challenges depending on, you know, if you're 500,000, if you're larger than $1 million, if you're even, I know we have one, and I'm not sure if this person is here, but from, you know, an organization that is about 1,200 employees. So that gives us a sense of who, you know, what's some of the challenges that may be coming up in today's discussion. And of course, we are also very interested in understanding why you are showing up today. You know, what is most compelling for you to make time out of your busy schedule to engage with us. And as the registration form asked you, one of the questions was, and it gave you multiple choices, what are you most interested to learn about or to hear more about? And we gave you 3 options, right? Communicating with funders, sustaining growth over the long term, and then making decisions, even though we are facing a lot of the unknowns today. And as you can see, a lot of you guys check them all, which for us is great because it means that you're in the right place. And, you know, we were prepared to speak to each and every one of these topics in varying lengths, right? So we are going to be able to really think about these subjects, but really through the lens of the budgeting tool and strategic budgeting and scenario planning. So those themes are going to come up again and again. And through that tool and those practices, we hope to sort of address some of these topics or shed some light on some of these questions here, right? And this is going to hopefully unfold for you all as we move forward. Very quickly, before we move ahead to the content, we just want to set some ground rules. And very briefly, I know that all of you guys tend to be very polite, and not that we feel the need to do that, but just to encourage you all to take care of yourselves. We're on Zoom a lot these days. And certainly you're welcome to turn on or turn off your video, you know, contribute via chat if you have a question. And we just want to encourage each other to really, you know, consider every experience to be valid, and that we often find that these spaces are really wonderful places to learn from each other. And so, but what is needed is actually that foundation of trust that when someone shares, that they will be respected and that point of view will be respected. So that being said, this is something that we, you know, invite you to consider. And certainly the way that we like to facilitate conversations is often we encourage you to ask questions through chat. As the facilitator, I won't necessarily be able to answer all of them. Jackie is going to help me look at the chat and really intrude, right? And just to tell me to stop, and so I can answer questions that way. So what are we, you know, how are we going to run today's conversation? I mentioned in the very beginning that there is a little bit of a new format for us. And what that means to us is originally, you know, we produce the content and we deliver the content live, 100%. What we've been recognizing is that we have been sharing the same content over and over again. And so what we've been able to do at NFF is start to record a series of webinars that address very common topics for financial management or related to financial management and strategic decision making that a lot of organizations, particularly those less than $1 million and even those larger than that, ask themselves, right? So a very concrete example that isn't showing up here today is cash flow planning. But so we have actually recorded a series of webinars for all to access, and we're going to give you those links towards the end and in our slides that you can access at will. And because we have recorded that, we thought that we could share some excerpts of certain webinars in that series that address some of the questions that you raised today. So I know that we asked you specific questions about what did you come here to learn? And then there was an open-ended question, what else? And we noticed that there were a lot of great questions that felt that some were connected to and some were connected to financial health, but perhaps didn't fit squarely within strategic budgeting and scenario planning. So for that reason, what we're planning to do today is show you excerpts first from the most from Annie's webinar, pre-recorded webinar, focused on strategic budgeting and scenario planning, but also excerpts from 2 other webinars that I think are going to be very interesting to you, because it raises concepts and showcases discussion between someone else who had watched the webinar and the facilitator, have discussed the answer back and forth between the question and answer. And I think that that might be of interest and educational for you all. And frankly, I feel as though it's sometimes nice to hear others ask questions that you have in your head, to feel less alone, that you are not alone in tackling or facing some of the challenges and questions that you have as leaders of nonprofits. Throughout showing the excerpts, we're not just going to be sitting here watching a movie together the entire time. We're going to do some pauses, strategic pauses, so that we can make sure that you don't have any questions about the content being shown. And if you do, that we'll have time to answer those questions then. So that's why there's a discussion in QA, roughly about 30 minutes of the 2 hours that you have today, but it's going to be kind of sparse, populated throughout sharing the excerpts there. And then, as Christine was sharing before, we are going to be standing by, if you will, towards the end for some office hours if there were questions that you wanted to ask that weren't addressed during the conversation, or that comes up after reflection. We are here until for the full 2 hours, and so whatever remaining time we have, we invite you to stay for 15 to 20 minutes, however time we have left, and to ask those questions. So a little bit of context before we start everything is that these webinars were originally created, right, under another initiative called Rising Together. The reason why I share this is because this initiative brought together organizations that were also largely smaller organizations, less than $1 million, and also, community-based organizations led by people of color, serving people of color. And so I just want you to say that just to let you know that we are listening to recordings that were originally designed for this initiative. So you might hear some snippets of references to this, and this is what this is about, as well as any of the participants of the pre-recordings that are asking the questions kind of come from one of these 3 networks. So just to kind of give you some context here, but as you can see here, the goal of this whole initiative was really to help community-based organizations sustain and adapt business models, right? So very aligned with some of the questions that you guys brought up, and I imagine that some of the goals that were shared by this initiative are shared or are of interest to you all as well. And the last slide before we jump right in, what is as part of this financial management series? There's actually 12 different webinars. Again, we're going to listen to 3 of the 12, and I've highlighted and bolded which one we're going to be sharing from, just little snippets here. So just to let you know that if you find these little excerpts to be interesting and you want to learn more, you can always go back to them and listen to the whole thing. And if you find that compelling, then I would encourage you to watch everything, especially if some of you are just joining and maybe are not familiar with financial management, maybe you're training new staff. We have a lot of wonderful resources on our website that I will share with you, Jackie will share with you, that you can share with your staff and colleagues. All right, so one last slide here, and then we're going to jump right into it. Just wanted to really focus back in, even though we are sharing pre-recordings from other initiatives, we are very aware of the needs of the community we're speaking to. Today, we're really kind of designing and putting together these pre-recordings, plus some live facilitation that's going to be largely run by Jackie here, to help us really focus in on strategic budgeting and planning. But really, why do we do that? It's really to help us navigate through decision-making, right? And to communicate to specific stakeholders that are important, whether or not they be board of directors or whether or not they be funders that are those funders, just like APCF, that are really much more like peer partners that help you build capacity, that you have very good trusting relationships with. And also we'll be addressing a little bit, or there will be space to discuss, what if those funders aren't so trust-based, and how do we communicate with them? And of course, one of the key things about planning here is really to help us think through and define scenarios. So all of that is going to be covered here in today's sort of like melding of the different excerpts, as well as the Q&A and Jackie's live facilitation here. So we're going to jump straight into and get kickstarted with Annie's webinar, which is the first one that we're going to be watching here. But before I do, are there any questions about who we are, the agenda, or anything else that any of you would like to share before we start? Okay. All right. Excellent. So let's start.
I share today. But really, some of the key considerations that we have as nonprofit leaders when we enter into thinking about doing strategic budgeting is starting off with what is the budget goals there. And for us, it's really reflecting on what your strategic goals are. What are your mission goals for your organization, the impact you want to have in your community? This budget should be one that sets realistic expectations, accounts for any restrictions or compliance needs in your revenue streams, and also considers surpluses to support longer term needs. What are the longer term needs that we need to save up for? And how do we do that by having surpluses year to year? Other considerations is to account for uncertainty. And that's something we're going to talk about more today, about some strategies for accounting for that uncertainty, because I work with leaders where oftentimes it's very hard to understand, especially if they're in early years of their nonprofit's formation or have faced a lot of changes, to understand how do I think about how uncertain revenue can be in the nonprofit sector and actually put down a number around that. Can feel very daunting to be able to do that. We're going to offer some strategies today to think through that together and know what it's going to take to reach your goals, so that you can think about from a very full perspective of what it would take to do what you want to do. And sometimes as leaders, we can be in a scarcity mindset of being able to be limited only by what we know we have 100% secured. So we're going to kind of balance those two things today, and as we think about revenue. And on the expense side, really thinking about our options. What are the options we have, the levers that we have if things don't work out the way that we anticipate? And usually those expenses are the ones that we have more control over, and really understanding what are our fixed versus our variable expenses that are going to have an impact on our organization. What happens when we pull some of those levers, so we can think about those things ahead of time before we actually have to make those pulls. And be clear about what those trade-offs are when we make those different changes. And for strategic budgeting, something that we always encourage is to really iterate on this. A budget is a plan for yourselves, but similar to when you make a plan for travel or a plan for an event, things will come up and will change, and being able to be flexible for that, but having to know information to inform that flexibility. Comparing your actuals to your budgets regularly, updating your projections if you have new information about your organization, so that it can be set against that new information. Making decisions once you start to see a certain path in your actuals versus your planned budget, and really using the budget as a communication tool with your stakeholders, your board members, your staff, your funders, to share with them what is happening around your plan financially. And just as a really grounding place of what informs your budget, for folks who are new to budgeting, these are some of the key things that often go into informing a budget for the next year, the next fiscal year that you have. Perhaps you already have some funding that's already committed for next year. You already know certain donors are going to be supporting you next year. You may know that a funder has said that they want to work with you in 2022. Maybe you already have a contract for that work. Some expenses already committed. You probably have an idea of what staff you plan on keeping next year, what your rent is, some of the other things that have been steady for you that you want to continue to pay for next year. Having those in hand. Looking at the prior year, typically organizations as a practice will start their budgeting for their next fiscal year about 3 months before the end of their year. So if your new fiscal year starts in January, leaders typically start having these conversations about what the financial plan is for next year around September, October. And in that time, you may be looking at what your actuals are. How did we do this year? You know, did we achieve what we thought we were going to do for our budget? Did we go over in what our revenues were expected to be? And using that information as well as your program outcomes and what were you able to achieve programmatically this year with your current budget to inform what you'd like to see next year and what your plan is next year. It's another data point. Strategic goals for your organization. Are there certain things you want to achieve next year, and start to think about bringing in what would it take to achieve those things? What was the financial needs to be able to achieve those things? And program and management staff input. We really find that organizations that work with their different staff across their organizations, their board members, to be able to inform and communicate about what it'll take to do the work. Because as a leader, you may not be as close to how far the programs that you lead may have made an impact, but maybe your program manager does, or maybe another staff person in your organization. And this all takes time. So wanting to share these all with you and making space for this, because it does take time to be able to put together a well-informed budget. As you're looking at the actual budget, this is an orientation to what we see makes up the budget. And just to be really clear, the budget is a financial plan, usually for a 1-year fiscal period, so 12 months. And the budget would include sections that are focused on your revenue streams. And here we see 2 different streams, both earned and contributed sources. Earned sources being fees for your services, things where you do a specific service and you get paid a fee for it. Contributed sources are typically including grants from foundations, private donations. Sometimes government sources can be contributed. Sometimes government sources can be seen as earned if they're paying you per your service. Those are different things that would go into your revenue streams. So that's really all of the money coming into your organization. And on the expense side, this is all of the money going out of your organization. Again, for a 1-year period, these are some of the major expense items that we typically see for nonprofits. Top of mind, personnel. Personnel is the driving expense for almost all the organizations I've ever worked with. And it's really because our people is what allows us to accomplish our mission. Professional fees, maybe contractors that you work with, marketing folks or graphic design artists or others that have a contract with you if you have an accountant or a bookkeeper. Occupancy being your costs of the space that it takes for you to do your work, maybe rent, lease, other things with utilities go into that. Specific program costs, if you are purchasing books, or purchasing other kinds of curriculum for what you're working on and delivering in programs, then that would go into program costs and other support expenses, just your supplies, where we've been finding in a virtual space, folks haven't had as many supply needs, but definitely something to take stock of because that's important for your organization. And any other expenses, folks, depending on what you do and your mission, you may have specific expenses that don't fit into any of these larger categories. And I'll say that we at NFF look at these functional expense categories because it tells something to us. It tells us about what it takes to do our mission. Some of you may have been asked other things around what's your fundraising versus your programmatic expenses versus your admin costs. And to us, that doesn't really tell us what it takes to accomplish our mission. So we really encourage folks to think about these functional buckets, especially in leading to telling your financial story, which I know with the last session that some folks may have just participated in too. When we think about revenue dynamics, we think about how does the organization generate or make our money? What are the ways that we do that? Strategically, are those working for us? What feels reliable or at risk? For folks who rely on funders who may change strategies, you may have different understandings of how risky certain funding streams you have right now are. And how does seasonality play a factor? Do you bring in your revenue during certain portions of the year? Maybe you get more commitments during the holidays when you have more campaigns going to bring in donations. It's important to think about these things as you think about when revenue may come in during the year, but really for that 12-month period where it's the seasonality. For expense dynamics, how does the organization spend its money? Is it predictable across all of these expenses? How responsive can we be to changes? How prepared are we to make hard decisions across all of these expenses? Are we planning for a surplus because we have long-term needs that we need to save for? And again, I hope you've heard this in other webinars, nonprofits can have surpluses year to year. And if you are trying to strengthen your organization for long-term financial needs, then we would encourage it too. When you're doing your budgeting, what we find important is, this often happens in an Excel workbook, but to be really straightforward with everyone, like some things that we find to be best practices is to articulate your assumptions. Have a notes column where you write down, like, this is how much I think I'm gonna, how many donors I think I'm gonna bring in to be able to make this total of $10,000 in donations. This is how many staff or part-time, full-time that I think is gonna make up this big personnel number that I have. Take your notes there so that you remember and you can revisit why you have the numbers that you do. Because 6 months later, you may not remember why you put that number down. And identify your risks in the same way, or potential swings. And just think about what you do and don't have control over when you think about your revenue and your expenses. And like I shared, most nonprofit leaders have more control over their expenses, but that's really hard to make those decisions to lower your expenses at any time. As one of the first questions we get is, how do I account for revenue when there's so much uncertainty? And I wanted to share today some really specific practices that I've used with leaders to be able to take that uncertainty and put it down into numbers. And then we're going to look at what this looks like for actual numbers. So starting with making a list of all of your confirmed sources of revenue, as well as potential sources. And when you look at the potential sources of revenue, doing a little bit of an assessment of why do you think they're potential sources? Are these funders funding the same strategies that you are implementing? Are they in the same geography? Do they have an open RFP next year that you know about? Listing all of those reasons why and assessing the likelihood of receiving that funding based on that, and how much they might fund, which is a really hard thing sometimes to do. But some tips I would offer is maybe looking at other grants that they have shared, if you have peers, other grants that they have made, or if you have peers that have received grants from those funders or from those donors, understanding about how much that they've received. It may help you make an estimate of what is likely for your organization, and using that to make a data-informed projection for potential revenue for yourselves. And sorry, I'm listing out these questions here that I just shared around assessing potential revenue sources. Once you have those different sources, one thing we want to offer to think about, like getting to a number, is being able to assign different probabilities to those sources. So for this example, if you
So did Emma's just internet just break? Is that what just happened? I think so. All right, apologies, guys. I think that clearly there are some internet issues on Emma's end. She was sharing the screen. And apologies for the gray box. It's a Zoom control, and I think she was trying to figure it out. And as we were chatting her, the gray boxes kept coming up, and she just couldn't move it. So hold on for a second. Jackie, I'm going to start to share my screen, but I'm going to, if you can facilitate any questions that may have come up before, and I'm going to go ahead and use my screen instead of Emma's and just find the right spot, if you don't mind doing that, Jackie.
Not at all. And a question that came in the chat is, will we be able to get the slides that were presented? And the answer is yes. You will receive an email with the slides after today's session. So you will have a copy for reference, and no need to have everything in your brain or screenshots or any of that. Like we'll give you the visuals that you've been looking at here afterwards.
And one thing I want to share too is that we were actually very close to a pause for questions and answers. And I know it was really disruptive, and I apologize for that. But just given everything that was shared, you know, are there any questions that you have so far? All right, I'm going to clear my screen here and try to find the right place. All right, some things, I'm going to start this again. Just note that it may be repetitive just by a few seconds or so, but I just want to make sure that we have everything. So hold on for a second while I share my screen. Make it big and
We're seeing the PowerPoint screen right now.
hold on for a second. All right. Here we go, one more time.
And we're not hearing any audio yet on our end, Sherr.
Yeah. All right. All right, so you couldn't hear any on mine, could you?
No.
Nothing? All right, apologies guys, but Emma is back. Emma, how is your internet?
I'm sorry, everyone. I just kept getting unstable notifications, but let me try again.
And Emma, one thing that I'd like to do is just to start back where, so there were no questions, so we can start right at, let's say, 21:25. For some reason, my sound is not sharing on my screen and my end.
Or a letter, I should say, to how confident you feel in that funding source. A is 100% committed. We've already signed the contract for this grant, so we know we have this $20,000. It's already coming in. B, the proposal is submitted and it's highly probable. You know, we've been invited to submit the proposal, we have submitted it, maybe it is going to the board, and so you feel pretty confident, but you can't say it's 100%. The proposal is submitted, for C, the proposal is submitted and somewhat likely. Maybe you feel good about it, it's more than 50% that you feel good about it, but there's still some uncertainty in whether it's actually going to come through or not. And D, it's really just starting discussions. We have we got a call from someone and they were interested in our work. So really in a very uncertain place, but we do want to account that there is somewhat of a likelihood that we could get this revenue. And lastly, E is a brand new relationship. We're kind of cold calling, or we're responding to an RFP and we don't have any idea of whether it's going to come through or not, but we hope it will. And here you can see just some examples of percentage probabilities that we would offer for each of these levels. At 100%, 90%, 60% is like moderate, you know, I'm feeling more than a 50-50 chance, 25% and 10%. And you could assign your own probabilities for this, you know, for whether you are, how risky you feel or how much, I should say, how conservative you feel like you should be in adjusting your revenue. You know, you can moderate, you can change the percentages to fit that. And how you would actually use it for the numbers is an example I'm going to give. So this one is using the discount method. So this is using the percentage to come up with an estimate of how much this revenue potential could be. So here for this ABC organization, we have a government agency, contract is signed. It's going to be paid via reimbursement, which is important to think about for your cash flow, but that's not what we're talking about today. So 100% probability, amount at 25,000. Reliable Foundation has strong alignment. It's been reliable in the past and they've kind of been funding us every year. So we feel good, but it's not 100% because the board hasn't approved it and we don't have a contract. So we're going to put it at 90% and we have a proposal out for $20,000. Sometimes major donor has strong alignment with us. They've come back and supported us on and off. They've shared their interest in renewing, but they really haven't given us a lot of information about what the grant's going to look like. So we would put them in at 60%. And in the past, they've given us about $1,000. This new corporation is engaged. We have calls with the management in the corporate philanthropy department, and they're interested in us. And they haven't really asked us for a final scope of work yet. But we've been talking about a $5,000 grant. So we're going to assign a 25% probability here. And prospects, these are folks that we are researching. You know, we have a list of maybe 20 folks that could give us certain different amounts. And if we averaged, I should say, let's do a different number. If we averaged for 20 folks, like $500 a person, I think that equals 5,000. Sorry, maybe if we did five folks that would average $1,000 per person, then it would be a total of $5,000. And this is a new strategy for us. We've never gone for donors this way, so we're going to assign a 10% probability. So this is what the amount would be in total. If we were just to add up all these total amounts, it would equal 56,000. But we know there's uncertainty in this. So when we apply the percentage to each of these amounts, then we have a discount amount. And then that comes out to 45,350, which is accounting for that uncertainty. Another way to do this is through cutoff methodology. So we have all the same information here, but we would cut it off at not counting in our revenue anyone that is below 60%. So we would only count in our revenue for our budget plan the ones that are above. And so that equals 46,000. So that is pretty close to 45,350 if you did it either way. So this is a way to make a plan for potential and revenue sources that is not 100% committed. But I also know that some are.
All right, guys, perhaps it feels like we're leaving you wanting more. And first and foremost, thank you so much for the grace that you're giving us in working out these tech issues. Emma, you're doing great. If you could open up the large screen whenever we're sharing the webinar, I think that would be fantastic and easier on the eyes for a lot of us here. So just to review, first and foremost, we will be sharing the deck. We will be sharing the recording so that you can go back and peruse the details again. And one of the questions I wanted to ask, and just to recap, we talked about, you know, what is a budget? What informs a budget? We talked about different revenue probabilities and how we either discount it, as Annie was sharing, or we do a cutoff method in some way where we say at a certain percentage we don't include. I'm very curious to hear from you all if there's any questions with the methodologies itself, that you guys have. And certainly if you're using one of these methodologies now and there is something to be aware of that you want the rest of the team to know about, we are open to that as well, to sharing that. Any questions so far?
Does anyone on this call have experience using one of these methods? Oh, I see we have a question in the chat from Bettina. Why was the C
budgeted
60% budgeted at 1,000? So in that example, I think you're referring to the cutoff method item. So for that, that was the one that was like that sometimes major donor that has really strong alignment with the organization, but is a little wishy-washy about whether or not they renew their gift on time every year. And so like sometimes they get it, sometimes they don't. They gave it a 60% probability. And with the discount method, what you would do is take the amount of the gift and multiply it by the percentage likelihood. And so for the discount method, you end up putting in that sometimes major donor, that $1,000 gift in at $600 because you're trying to account for some of the risk by reducing how much you're planning on getting. With the cutoff method, because the organization set that cutoff at 60%, that gift actually made the cut. And so they count everything that is above whatever their threshold is at 100%, and then everything that's below that threshold at nothing. And the version that works best for one organization may not be the version that works best for another. But what we tend to see is that organizations that have really wide ranges in the sizes of gifts, like they're getting lots of smaller gifts and maybe like one or two that are really big outliers that are really significant. The cutoff method can sometimes be a better choice for that situation because the really large gift can end up obscuring the results, even if the likelihood is small. Because let's say that you've got a lot of gifts around 5,000, 10,000, and then you've got one that's 200,000. Even at 10%, that's going to be a really big chunk of your budget. So that is kind of the way we recommend starting thinking about that. But Karen, you say that you use the probability method, and I've certainly used it. I'd love to hear if you're willing to share a little bit about how that has worked for your organization.
Yeah, thank you. I think we use a version of it. So similarly to the percentage, we just go through our corporate sponsors or folks who have donated in the past, and we go through and kind of project whether they're high probability of donating again, how much, depending on the historical trend of their donations in the past, and then the relationship. So depending on who brought that donation in, connect it with the board member or the member that was the main contact for that donation, and then reach out to them to start cultivating that donation to come back, or reach out to the folks who maybe wanted to donate, but didn't. Something happened along the way, so reach out to those early on. So that's kind of the version that we've used.
Thank you for sharing. Sorry to jump in, Jackie. I just wanted to celebrate the fact that, or just highlight the fact that already you're mentioning something that's really important. And I think one of the best attributes of being very specific about assigning probabilities of risk is that you have to talk to each other about what that risk is. And that is probably one of, I think, the most valuable takeaways, or the value of this is, yes, it gives you a number, whether or not you use the probability method or the cutoff method. But it just forces you to talk to each other and say, what do you think the probability is? I mean, you're nodding your head, Karen, so I assume that that is something that comes out of this process. Great.
Yes. Also to question, the relationship, right? Is it a strong relationship that either our board member or member has with this corporation or contact person? Can we develop it more? And it opens up the conversation with, well, maybe they donated 1,000. Do you think that you can go back and ask for more this year or something like that? So it does open that line of communication.
Yeah, fantastic. It's very true. And also that we're going to be talking about this in a little bit, but some of you had asked in your registration information that one of the challenges that you guys are dealing with is just communicating with funders about the performance, right? And so I think the communication with funders is a very large territory that really does reside on that conversation, like how strong is your relationship with the funder? And one dimension of strength is, can we say what we really mean with these funders? So we're going to continue that conversation a little bit because I know communication is a strong theme here. So, but thank you for that, Karen. That's very helpful. Is it Bettina? I hope I'm saying your name right. I just wanted to ask if you had your question answered, just to make sure. Jackie kind of described it really well, but just want to make sure that you still didn't have any questions before we moved on.
Bettina actually messaged me privately and said yes.
Oh, perfect. Okay, thank you. Perfect, wonderful. All right, for the sake of time, we're going to move on. Now, we had just talked about revenue risk, right? And so again, discounting and cutoff method are the two ways that we recommend thinking about, and a lot of organizations have done. There's no right way necessarily, but some people have blended the two in some way. But those are the two kind of common approaches. And so if you're not doing that with your revenue, especially there were a lot of questions about, there's a lot of uncertainty. Like we got a lot of funding during COVID-19 to stop the hate against Asian movement, which is still very much thriving, but there are concerns about that stopping, right? So revenue uncertainty is probably one of the most anxiety-provoking experiences of a leader. And we find that being able to articulate whether or not it's probability or whether or not it's cutoff method, those funding and really scrutinizing funding on that level is helpful. So it's a practice that we recommend you guys adopt and think about if you're not using it already. All right, so we talked about revenue. Let's do quickly about expenses. So we're going to continue watching Annie speak through expenses, and then we're going to pause for questions.
So for forecasting expenses, two of the main kind of frameworks to think about is whether your expenses are direct expenses versus indirect expenses or fixed variable. So expenses are typically more within our control. Like we can make the decision on whether the expense is there or not. The hard part is by cutting an expense or increasing expense, you're having an impact on the organization. So wanting to use that decision making with data behind it. One way to think about your expenses that's important is whether it's a direct expense tied to a program or an indirect expense that's organizational wide. So things like your utility bill, your rent, like we need those things whether our programs come or go to a certain extent. If you have a space for after school programming, then that space may be a direct program expense, because if that program went away, then you wouldn't actually have that expense anymore. But it's important to kind of think through your expenses this way, because they're more maybe expenses that you on the surface think are direct, but they have a hit on the whole organization. And quickly, an example of that is that an organization that I worked with, they had to make some difficult decisions on cutting down their expenses. And so they let go of an administrative assistant because they felt like the tasks that they were doing, each of the program directors and teachers, it's an art center, could do that on their own. So they said, okay, this is something that feels like it's more about like an administrative expense that everyone can have an impact on, or everyone could take care of on their own. It ends up that enrollment went down after this woman left. And when they kind of researched it, they found out that the woman had actually been calling all of the parents to remind them to sign up for the next class. And no one had kind of been tracking that. So it had a programmatic impact. And I offer this just to say, like, as you make difficult decisions, it's helpful to think through ahead of time, you know, understanding your expenses and what are they really contributing to your organization. Fixed expenses are ones that don't change when we do more or less, and variable expenses are ones that increase or decrease based on how much activity we have. So it helps you to understand next year, if we did more, would we expect our rent to increase? Probably not, unless we got to a certain point of size. But would we expect our electricity bill to go up because we have a lot more staff? Probably, you know, or other things on supplies or other things that would go up if you did more of what you're doing. I think there's something in the chat. Oh, great. Yeah, good things to consider on the expenses. So overall, your budget is really a tool for you. And if I didn't say this already, your budget can be one where you have your own very detailed version for yourself. As a leader, you know, you can keep all of your notes there, understand what happened. It can illustrate what happened and why, showing your notes, your assumptions, tracking the variance between the actual amount of revenue and expenses you had versus what you planned for in your budget. And that doesn't have to be what you submit to your funders or for your compliance documents. You know, those type of budgets serve a different purpose. So just wanted to kind of empower you all that those budgets for your internal management are definitely a tool that you should and could use. And it helps you to support real-time decision-making if you have thought ahead of time about what the impact of those expenses or revenues are on your organization. And that's what we're going to talk about next in scenario planning. Just going to give you a overview of what a scenario plan could look like, which I know has been of top interest for folks in the Rising Together work.
All right, and just to let you know, again, we're going to speak about scenario planning in a little bit, but before we kind of move forward, are there any questions about expenses so far and what Annie shared? Okay, wait, 5 more uncomfortable seconds here, just in case you guys are reflecting on this. Okay, great. All right, so I just want to kind of recap that the takeaway for the expenses here is it is a lot easier to predict and project expenses, but we understand that many of you have faced a dramatic growth through the period of these past couple of years, COVID-19 funding and unexpected funding. And the question then becomes like, is it sustainable? Is it going to come again? Is it repeatable, reliable? And in the funding cycle, you had hired a lot of people, right? And so a lot of you are facing challenges of sustaining that cost structure. One of the things that we want to start you guys thinking about is, you know, typically expenses are a lot easier to project out, right? Because of the fact that, you know, you can control. It's just the sphere of control. Use that to your advantage in the sense of start sometimes, you know, I know we started with talking about revenue, but it is also helpful for us to think about thinking about the expenses that you need unapologetically and really understanding the needs if, for example, you were to assume the same level of funding that you're getting. You know, what do you want to do in light of the fact that you've got your mission goals, your programmatic goals, and to really understand the cost structure really, really well, so that if you are to be asked by a funder, you can quickly respond what you need and why you need it. So those are the things. It's a little tug of war between revenue and expenses. So just to say that it is just as important to really think about expenses, but the risk profile looks a little bit different. But our approach has been really to think very critically about what it takes to run the organization and almost to do it as a separate exercise, right? Instead of thinking, well, how much money is coming? And then I'll design my staff. Really think about, if you're just not considering revenue realities, what is it really going to take? But of course, we know that those things are going to have a conversation together at some point in time. So one of the other things that, and we're going to show another clip now from a colleague of mine, Johnny, who did another webinar in this series focused on managing risk and opportunity. And the reason why I wanted to show this excerpt is because he's going to speak through really, setting up a budget where you really start to show a budget with these longer term needs on your budget. And what does that mean? Below the line budgeting, right? One of the questions that we got from the registration was, what is appropriate for reserves, right? What a 6-month reserve, is that appropriate? And I think reading behind that and something that we've heard from other clients, how will funders perceive that? So there's a nice conversation that happens between Johnny and one of the participants of the Rising Together initiative that asks about, we have this surplus this year and our funders asking us about it. How do we respond, right? So let's watch this and I'd love to hear from you all whether or not you're in this situation and whether or not we can provide any support after that. But Emma, if you could just share and start Johnny's excerpt, please.
So the reality is that consistent surpluses build liquidity, adaptability, and durability. This is generally how we think about what happens on the finance side and what we know is helpful in building up financial health. But we know that the reality right now is that surpluses may not be realistic. And that might be fine if you have the cash or other resources available to support it. It takes plenty to adapt your business model and to build the resources dedicated to serving your mission in the short and long term. Really building liquidity, adaptability, and durability comes from 2 sources. The first is through surpluses. So really a strong business model is one that throws off surpluses sufficient to invest back into the organization. When showing surpluses gets pushed back, oftentimes what we hear from organizations is, I'm showing surpluses, I'm trying to communicate this to funders, and funders just don't want to see a surplus. Donors just don't want to see a surplus. They're hesitant. They're asking me, why do I need a surplus? Why don't you just, do a zero bottom line? And so how do we communicate this? How do we let them know what these surpluses are meant for? So again, one of the challenges is communicating the use of surpluses. Again, what happens when a funder or sometimes board members demand a bottom line? The first step is to explain why. Budgeting to break even will not cover all of the organization's costs, and it undermines the ability to deliver on mission in the long run. Also show it in your reports. Indicate plans for the use of the surplus line to demonstrate good management and satisfy the request for a balanced budget. So what does below the line mean? On this slide, you can see what a budget is. So we have our revenue, our expenses for this organization, for this example of ABC organization. And on the bottom, you can see the addition of the amounts and the notes or assumptions. So what we see for revenue is that this organization is planning to have 190,000 in revenue for FY21. And expenses, they're planning to spend about 177,000, which leaves them with a bottom line of 37,500. Now, of course, if they were just to show this top part to a funder might say, well, it looks like you're about to have a $37,000 surplus. Why do you still need my funding? And so this is where including that liquidity needs, your balance sheet needs are really important in your budget. Because if we include your goal of having working capital of $50,000, again, determined by a cash flow projection tool that you have said, I just need this cash on hand to manage my day-to-day needs, to manage, paying my people on time, to paying my bills, to ensure that I am just able to operate as an organization throughout the year. 50,000 is what I need. I'm also hiring some new staff, right? And they're going to need some laptops. We're remote. It's all about technology at this point. So I also need $5,000 for fixed asset additions for some laptops for my new staff. So now I actually need $55,000 to cover my working capital on my laptops, which then we see that our original $37,000 surplus that we were projecting is now putting us at a deficit, right? And so it's no longer of, I'm planning to have a $37,000 surplus. It's now, yes, I'm going to have a $37,000 surplus for my budget, but I also need these balance sheet needs that, again, are really important for my organization just to manage my operations. And those needs exceed what I'm currently projecting as my surplus. It puts me at a shortfall, it puts me at a deficit. And so funder, this is why I still need your money. This is why I still need your funding this year. And so it takes control of your narrative and control of the surplus and really shows the planning that you're putting into in terms of addressing your liquidity adaptability needs. Any questions on this example, or perhaps any experiences that you all have had, either communicating a surplus or some pushback that you have all received, whether from a board, from a funder? It's also, I've seen common that some staff also push back to showing surpluses. So I want to see if there's any reflections here.
I just applied for a capacity grant, and after I submitted the grant, I was told that I have to explain to them my budget and my financials to let them see where the gap is, like basically why I'm not paying for the request with my general operation money. And the truth is that we do have general operation money, but I wanted to save it, you know, to hire more staff and like also for like a rainy day fund. But I don't really know, it's really awkward that they schedule a meeting with you just so that you show them you don't have money, sort of. Like, how would you handle that?
Yeah, that's a really great question. And one of the unfortunate realities are the dynamics of the funding sector, right? And that really goes into what we've been trying to cover, right? Often nonprofits, we're so used to operating from a scarcity mindset. We're so used to having to ask for funders, you know, for money, and then funders saying, well, it seems like you have enough. Why do you still need my funding? Why don't you just cover it from your general operating? And I'll note that not all funders are at the place where, you know, as we mentioned, they're comfortable with seeing surpluses, or they're still demanding zero bottom lines. And so for like your situation, again, I would recommend following kind of this layout as well, right? Showing, kind of explaining in the narrative in your budget why you have that reserve, what it's used for. If you have some board policies around that reserve, right? Like say what it's for, like I can't touch this money until it's a rainy day fund, perhaps maybe another, you know, natural disaster, a lapsed funder. I can't touch this because my board has said that I can't use it until, you know, X, Y, and Z. And so then you're going back to the funder and saying, yes, I have this, but I've planned for it. I'm unable to touch that. I still need your money for these other things, which are really important for me right now. And list those needs in your budget, list those needs in your narrative. Again, and really showing them, yes, I have this money in my reserve, but it's for this specific purpose because I planned with my board that this is where it's needed right now. And on the flip side, your money will be going towards these things that just that reserve can't cover. So does that make sense?
Yeah, I guess my question would be that I would have to basically have an explanation then. Like I couldn't just say this is just sitting here because we're not sure what's going to happen in 2022 or, you know, whatever. I basically just have to, what I'm hearing is that I have to be very clear about how the money is going to be used and what's the intention behind not using it for the capacity request.
Absolutely. Right. Absolutely. Yeah. Be as explicit as possible, right? Because sometimes when we're not, what will happen is what's happening with you. We'll let the funders connect the dots. We'll let the funders control your own organizational narrative. And the reality is that the funder doesn't know your narrative, right? They don't know your organization's situation. You know it as the leader of that organization. You know what is best. And so take control of that narrative, be as explicit as possible, avoid having the funder connect the dots and make assumptions. And so hopefully that will allow the funder to really see that whole picture and make less assumptions about your financial situation. Really great question.
I thought that was a really nice, illustrative conversation that we see a lot in the sector. We had some nice chat happening here while that was being viewed, and I'm very curious to see and hear from you all. And just to kind of recap Christine's questions, is if any nonprofits here have reserves. Just curious. I know that some of you guys have faced a lot of surpluses this year. If you do have a reserve policy, are you setting that aside? Wonderful, Sonia. Sonia says, we have reserves for the first time and would love to hear how other folks have used their policies. Yeah, Chunyan, welcome. Great. So yes, I mean, reserves generally speaking. So just to kind of go back to Johnny's presentation here, in the very beginning, there was a cycle of health. We started off this excerpt saying, consistent surpluses build liquidity, adaptability, durability, right? And part of the reason why is because those surpluses translate into reserves and savings. And so these reserves policy, I'm trying to weave this here, is something, if you don't have one, would be good for you guys to be intentional about setting one aside, because one, it helps generate conversation internally about leadership. Like, what do you do with the surpluses that you have? It makes you start thinking about your longer term needs, what could happen. And then also you feel better as a leader, knowing that you have some savings just in case something unexpected happens. And as today's demonstration of failed internet and, things as much as you put thought into the plan, unexpected things always happen, right? So reserves are good. So absolutely wonderful. If you have reserves, if you don't really start to think of one. And Karen says AAPA has a reserve policy and you had to dip into it in 2020 and tried to recover reserves in 2021. That's great. And then Kan Chan, I hope I'm saying your name correctly, for cause says, yes, we have little reserves and would love to know how they are treated in the balance sheet and policies for it. Okay. And then we just met yesterday for work. So Kanchan, just as a side note, they do show up in the balance sheet depending on, as your asset, right? Now, depending on how you treat it, now I'm assuming this is a board designated reserve, it could be treated as either a liquid, if it's like an operating reserve, it can very well be a liquid asset, something that you are able to access, right? And the reason why that I am making this distinction is depending on the level of restrictions that you put on this particular asset that sits in your savings account, it can show up as a restricted asset, which has an implication on your liquidity. What I mean for that as an example, as an endowment, would be the extreme example of one that is completely restricted. A board designated reserve, however, usually is unrestricted, doesn't have restrictions placed on it. I have seen, however, some board designated reserves have such onerous restrictions on them that they have chosen to represent it on the balance sheet as a restricted asset, just because it reflects, it's not necessarily GAAP compliant, but it's something that internally they treated it as very much as a restricted, so that they could actually get a better sense of what assets they have available for their use. I hope that's helpful. All right, there's a lot of chat here. I'm starting to say that I've missed everything, and I'm not sure, Jackie, if you have something else. So Kanchan has, so the policy is one thing, just to complete this. that is something that we'll do some research on it, but if you can reach out to us, I think we do have some example reserve policies that we can share with you, as well as some idea of where to look in our financial management webinars in order for you to get a better sense of how do they show up in the balance sheet. There are actually some webinars that are very detailed about that you'll walk away with a very sound understanding of how that looks. As well as we could share with you some language as well as what types of reserves, right? Because it's not just operations. It could be research and development. It could be, you know, there's a number of different reserves for fixed asset replacement. So just letting you know there.
Yeah, I think the other thing that I would raise up from what's been going on in the chat is, you know, some talk about the role of the number of months in terms of what that means for a meaningful reserve. And really that is something that does to some degree depend on the situation that an organization is in, like one that deals with a lot of reimbursement-based funding might need more months of cash on hand in order to be able to meet its needs while it waits for all those invoices to get paid, than one that has a lot more upfront funding where they don't experience quite as many cash flow crunches. So the needs that an organization has can really depend on their situation, and also they can change over time, because one thing that's important to think about is, you know, if your organization's budget has grown or is growing in the next few years, then what it takes to make up 3 months of cash, that number is going to grow. And so those are things that are kind of always, you know, a bit dynamic for organizations. And so it's good to establish those policies for your organization, and then it's good to check back in and see how they're tracking with your needs over time. Because if you've got a reserves policy that was written 10 years ago, things might have changed, and it might be time for your board to take a look and just see, like, is this still working for us, or do we need to, you know, adjust how we look at this? Which is a roundabout way of saying it depends. But it truly does.
It truly does. Thank you. At least you said it in the end and not in the beginning, which I tend to do. So that's good. Yeah, we're happy to dig up some reserve policies, but there are some, what I would recommend is watching certain webinars about, you know, full cost balance sheet health and why it's important, just because we do break out the different types of reserves.
Yeah.
And one thing to add to what Jackie was saying, Jackie's salient points, is back to how do we communicate with funders, right? So that example was about a funder being, you know, curious about, you know, why they have surpluses and what that's about. And Christine's earlier point is some funders just want to see a reserve policy. So having that set for you all, for yourself internally, will help you talk to the funder more confidently, right? So, and there is still, unfortunately, it does still exist in the sector where funders believe in zero budgeting, right? Like that you have to spend everything. And if you have money in the bank, that maybe there are more worthy organizations that need your money. What I will say is that the sector movement, philanthropic movement, thankfully is moving towards not really focusing on that anymore. But unfortunately, there are still foundations that, you know, expect that. But I'm happy to say that it seems like the trend is moving away from that. So yes, perfect. Okay, so I'm going to turn it over to Jackie. Now we're gonna be live facilitating now. So no more. Thank you, Emma. Thank you so much for working towards it. We on ourselves will fix those gray boxes. But again, this was the trial run. So thank you for testing this out through us, and hopefully that was helpful too. Okay.
Thanks, Sherr. Thanks, Emma. Thanks, everyone. So what we're going to do now is we're going to talk a little bit more about how to think about those reserves. And oh gosh, it looks like I might be freezing. Can someone tell me if you can still hear me?
I can hear you.
Fantastic. Okay, I think I had a little bit of a blip. Okay. Thank you. Okay, so Emma is going to launch a quick poll for us to just get a sense from all of you. With we've heard from a lot of organizations over the past few years about the role that emergency funding has been playing and how it's been changing organizations' financial position. And so whether you got Paycheck Protection Program funding from the federal government, you got one-time emergency grants for COVID, or you got a lot of influx of funding from the Stop API Hate campaigns last year, or some other situation that has led to your organization having a surplus that you're looking at how to deal with. We wanted to just understand how you're thinking about planning to use those funds. Are you in the process of trying to figure that out right now? And is this something that is just like not your organization situation? We want to know that too. And so I see folks are answering. We'll leave it up for another couple of seconds, but we've gotten about half of you participating, so thank you. And it looks like so far what we're seeing is a really good mix. We'll give it another couple of seconds, and then I think we can go ahead and end the poll. But what we're seeing is that the majority of you have some kind of surplus. About half of you are looking at expanding something, whether it's your programs, your infrastructure, your team, your compensation. There's about 20% of you who are directing your surpluses toward your savings, and there's 20% of you who are trying to figure that out right now. This is the question of the moment, and 13% of you do not have a surplus right now. So that is just to know you are in company here if that is your situation, but we would like to use this scenario as our example as we walk through scenario planning, so that for those of you who are going through this or have just gone through it, or hope that you will be dealing with this scenario in the future, we want your questions. Please keep asking them as we go through the next part here. And with that, I'm going to keep us on our friends ABC organization and the scenarios that they're considering. So they do have a surplus thanks to the extraordinary funding opportunities they've had, and they're starting their decision-making process by comparing two core scenario options. On the left, this organization is looking at one scenario where they keep the surpluses they have from emergency funding for savings. Doing so does not impact their budget, but it does grow the financial resources they have available for emergencies, for the unexpected, and so on. This could be the first time that they've had savings, which they can then use to establish a safety net for the first time ever. Or maybe they had an existing reserve, but it just hasn't been enough to meet their needs, so they're going to add to it with this surplus. Either way, as we've been talking about, those ground rules, those policies about what constitutes the kind of situation where they're going to be okay dipping into that fund and what they're going to do to try to replenish it over time, that's going to be really important for them at this moment. On the right, we have a different option where instead this organization is taking those savings and investing them in things they've needed for some time but haven't had the flexibility or the means to pay for. This might be improving compensation or benefits for their team, hiring on new positions to grow capacity, increasing programmatic offerings, purchasing software, equipment, other forms of infrastructure. Any of these investments, they could really improve working conditions, they could help meet rising demand for their services, or otherwise increase the organization's effectiveness. These investments would also increase ABC organization's expenses. And so for those expenses which are ongoing, and most of what I've described here would likely be, it's going to be very important for them to identify future sources of revenue that are going to sustain those types of budget increases in the long term, because once this surplus is spent down, they'll need other funds to be able to continue to afford that investment. And so for whenever your organization is weighing different scenarios, it's important to think through, like, define what they are and think through the implications of each option, and what's right for one organization at one moment in time might not be the best option for another, but ultimately it will be up to your organization to determine which of those paths is going to best meet the needs that you are facing. So with that, we're going to dive in a little bit deeper on these scenarios, and we're going to look at, okay, what do these options look like, and what would the financial implications actually be? So earlier we were talking, when Johnny was showing those below the line items in the budget presentation in his video, here we're just going to keep this really simple for the sake of looking at our scenarios, and we're going to stick to just those operating revenue and expense pieces. And as I go through the various scenarios here, imagine that ABC organization surplus from this time is $50,000. That's what they're trying to decide how to use. So what we see here as we start is their initially adopted budget for FY22, which has essentially break-even results. And this is the organization's baseline budget that reflects their current operations. One of the scenarios they're considering is making no changes to their budget. Their savings will be around in case of cash flow crunches, which, they have a pretty significant amount of government support that might be reimbursement based. Could also be money that's around for other emergencies, but they're not going to use it to fund any operating expenses. So really that $50,000 surplus, that's going to give them, a couple of months of breathing room while they, whenever they have a tight cash flow moment. Then we move on and we look at scenario A. Scenario A is ABC organization is asking what might happen if they give their team a 10% raise to help combat rising inflation. In this scenario, the raises would not come with the expectation that they're going to take on more work. They are simply addressing the increased cost of living. So they hope that by increasing compensation, they'll be able to retain existing staff, fill vacancies in a reasonable amount of time, and continue to be able to carry out their work as they planned when they put together the budget. It's just costing more to do what they did before, and they're going to have to hope that their savings can carry them forward for now while they work on negotiating funding increases in the long term as their contracts and grants come up for renewal. You can see at the bottom here, under this scenario, they run a deficit this year of $21,000. So they can use that $50,000 surplus to carry this plan forward for about 2 years. But the questions they're going to need to ask are, when do their major contracts and grants renew? Do they have a sense yet of whether their funders are, thinking about inflation and will agree to increases without requiring more activity? So, if they're confident about that, then this is a path forward they might be comfortable taking. Then we have another scenario. And in this one, we're going to take the same approach line by line, but what you're going to see is that ABC organization is looking at a different situation where they are spending that money in a different way. They're adding a full-time position to the team, managing volunteers, supporting fundraising efforts, and that is going to free up program staff to have more volunteer support and to spend more time on program delivery and less time on grant reports. And it's also going to free up the executive director to spend a little more time developing relationships with supporters and partners because they've got someone helping them with all the paperwork and the behind the scenes on all of that fundraising activity. So they're thinking with this scenario is that if they make this investment in time, they'll be able to generate more revenue and better meet rising demand for their services. So strategies like this, where you're expanding capacity and changing the formula for how your organization works, those tend to take, several years to fully bear out in terms of how much additional revenue you're ultimately able to generate. New employees need to learn the organization, get to know the community, build relationships that can generate more support. And, in this example, get through a new funders grant application and review process. So this organization is making a big upfront investment with the goal that in time it's going to pay off and become more sustainable. So, you can see here through all these lines, they've got increased activity because their program staff can do more with their volunteers and with their extra time that they've got now. So there's more money coming in from their government contracts. There's also more supply expenses. They're doing a little more fundraising in the first year. And so their overall revenue increases, but their overall expenses increase more, and they end up with an operating deficit this year of about $40,000. So what that means is that they're spending almost all of that surplus this year, and they're seeing initial results in the increased revenue. But for this strategy to pay off long-term and be sustainable, they're going to have a really clear plan for how they're going to continue on that path of growing their revenue next year and beyond in order to meet that increased budget beyond this initial time period. And so what this exercise gives you is a tools that you can use to consider how these decisions would impact the organization financially. And what I hope that this helps illustrate is that taking these scenarios and pulling them out of your head and into something that you can look at and share with others can be a really helpful process for thinking through implications and of the options that you're weighing. And it can also really help generate discussions with others about the assumptions that you're making, the possibilities that can come with each scenario, and what it is you'd need to plan for in order to make these scenarios actually viable for your organizations. And so with that, the next piece we have here is something that Sherr, I'm just going to do a quick time check.
Yeah, I was going to stop and just check. If you can stop sharing for a second, I wanted to ask you folks what you wanted to do. We did have one more excerpt, which is roughly around 10 minutes or so, I think roughly 10 minutes, by our longtime consultant who used to be an NFFer, Michael Cass, and he speaks through a way of making decisions. And the reason why we brought that is because there was a question about how do I know when to accept funding, right? What if there's a moral quandary around accepting funding from a funder that maybe isn't as morally or values aligned as we would want them to be? And beyond financial impact, so Jackie went through scenario planning and showing the impact on finances. And we understand that decisions aren't just about financial impact. It's about mission impact. It's about a number of different criteria. So Michael goes through a very nice framework called we call it decision-making tool, decision-making framework. So we can spend some time doing that, or we can pause. Jackie has just one more slide to share about communication, and then we can spend the rest of our time just answering questions. And we can, of course, in our follow-up email, tell you what to watch and what we were going to share anyways. And you could get that, later as well. So I wanted to pose it back to you guys. If you guys could chat in the email, would you like to continue watching our next segment, which means we wouldn't have time for office hours, if you will? Or do you want to just, let's close up and then we can just dedicate the rest of our time to questions? Just a few responses just to let us know what you guys want to do. Okay. All right.
Great.
So let's do it.
So let's start with decision making. This is a really powerful tool. I'll share a story in a little bit about how this would, an organization we worked with, Christine, I think it was like last week, 2 weeks ago, really was able to use this tool to make a complex decision much more easily understood. So here's how it works. Over on the left, we have a set of criteria that the organization wants to track, wants to know how a scenario will impact each of these criteria. For this organization, they chose the impact on their mission, the impact on their staffing, the time horizon, so just like how soon it will impact the organization, what the level of risk is, and the financial impact. And so this organization was making a decision at the beginning of the pandemic. And the first scenario they looked at was creating a new online program for youth. The first thing they realized is that the mission impact would be both positive and high, right? This decision was highly aligned with their mission and would help them maintain their connection with students and maybe even create connections with new students. So that's great for them. The staffing impact would be minimal because they would be able to use existing staff. They would neither have to bring anyone on or let anyone go. The time horizon was immediate. They were having these conversations, I believe, right around this time last year. And so when they made this decision, it would impact them just 2 months in the future, in early fall. And the risks for this scenario for them were low. And it's really important looking at this to understand why the risks were low. So first of all, they already had experience in online programs. As many of us has found over the last year, if we don't have experience in online programs, setting them up is a whole thing. There's a lot of moving pieces, but they already had the experience for that. They also already had their curriculum built, and really importantly, they had funding identified. So there was no financial risk involved in doing this. And because of this, the financial impact was neutral in their analysis. They already had $5,000 in startup costs committed, and the teacher salaries were already in the budget, right? This would have no impact on their financial bottom line and an incredibly high impact on their mission without impacting their staff. So that's one scenario they were looking at. The second scenario they were looking at was pausing their youth sports program altogether. And here was their analysis of that. The mission impact was negative and high. It would mean cutting a program that was really core to their mission. The staffing impact would be moderate. 4 staff would be effective. If they were to pause that program, they would have to let 4 staff go. The time horizon, again, was immediate. This would take effect pretty quickly. And the risks, again, are low. And now we'll look at the reasons that the risks were low. It's very different, right? All of their peer programs were also paused, so they wouldn't be falling behind. The funders that they had were supporting general operating services, meaning they didn't have any money that they were only allowed to use for this program. They would be able to repurpose it for general operating support. And they wouldn't lose contact with families because the families, most of them were already in other programs. The financial impact would be moderate. They would save 10% of their overall budget. They wouldn't necessarily have guaranteed revenue, and it would be more costly to deliver in fiscal year 21, but for this year, they would save 10% of their budget. So looking at this analysis, it might seem really clear, or it did to me the first time I looked at this, that, oh, they should definitely start the new online program for youth, right? There's no financial downside, neutral impact on budget. It's really aligned with their mission. They'll be able to keep their full staff. There's no risk to it. But what we don't know, what this doesn't tell us, is how important this 10% savings is to them. If this organization is in financial crisis, then it might be that for them, despite some of these drawbacks, having to lose 4 staff, that 10% could make a huge, huge difference for them. And this goes to point out that there is no perfect decision. And one of the things I love about this structure is that it helps us see what trade-offs we're making anytime we're making one of these decisions that contains so many variables. Nothing is going to be on top for every consideration, and there's always trade-offs, right? And it's also important to remember that just because we've done this exercise once on one day doesn't mean that the analysis is valid 3 days later, because things change. So we always want to iterate. Now, here's how this could be useful. We were talking with an organization last week, apparently, thank you, Christine, that was in a situation, they had 3 scenarios they were looking at, and the executive director's mind was spinning because there were so many variables. And although she sort of understood what was going on herself, she could not communicate it to her board. And she had a board meeting coming up the week after we were meeting with her. And so we reminded her of this tool, and she was able to identify the criteria, the variables she was looking at, and feed each of the 3 scenarios into the tool. It really helped her clarify her own thinking, and even more importantly for her, communicate it really clearly and powerfully to the board of directors so that they could make a really informed decision on behalf of the organization and its mission and the people that they serve. There's another aspect to this, right? That's a very data-informed approach. as we all know, when we're making decisions like this, in times of crisis especially, but really anytime, these are not just financial or mission decisions. These are human decisions. Emotions can run high because they're impacting people who we may consider to be family, right? And we want to make sure to acknowledge that. And the most powerful way to do that at the beginning of these conversations is to acknowledge everyone's interest and acknowledge that there is emotion present in the room, right? We don't suddenly become decision-making robots. We want to make sure that everybody understands their role in these conversations, right? Ideally, we have a wide variety of stakeholders involved, but staff is going to have a different level of interest and different role than board will have a different role than funders, right? We want to make sure that everybody understands their role and how they can participate. Ideally, everyone involved in these conversations agrees on the end goal. And that means maybe agreeing which criteria is most important. So for example, in the example we just looked at, it might mean agreeing, hey, no matter what, we need to save that 10% on the budget, no matter, that's our priority. Or it may mean agreeing that the priority is the making sure that we stay really strongly focused on our mission, right? Now, sometimes even agreeing on that goal at the outset of one of these conversations, it creates tension. It can be difficult. So if we can't get to a shared goal, at least we can try to agree on the guide rails. So there was an example of this a few weeks ago. I was helping facilitate a difficult process for an organization, and they couldn't agree on a priority for it. They could not agree on what they were headed for. But what we could agree on is this meeting is going to take 2 hours. And here's the process that we're going to use to go through it. And by the end of this, we hope to have arrived at a goal, right? And this was a little bit frustrating for them at first because they really wanted to just make the decision that day. But what ended up happening is by slowing down and taking the time to have that conversation about the goals and the guidelines, the guide rails, they were able to save a ton of time arguing on the back end, right? So by slowing down at the beginning, we're able to save time in the long run. And if all else fails, and maybe if all else isn't failing, it's always a good idea to sleep on it, unless the decision has to be made now. Sometimes when we sleep, some of this information and the conversation digests and integrates differently, and we can move to it with clear eyes the next day.
So one thing with that video, we saw a little chart that Michael used that showed, a few different criteria that you can use when you're weighing different options and trying to, figure out prioritization. And some of the items on there were things like the financial impact, the mission impact, your capacity, the timeline, and so on. We're wondering, when your organization is weighing options and trying to decide what to do with different scenarios, is there other criteria that you use that that has helped guide your organization in navigating this process? Or do those feel like the ones that you would want to use with your organization if you were weighing these kinds of choices? And what Emma has just put in the chat here is a document that you can click to download. It's something that we call the decision matrix, and it's a template that you can edit. And so if it's helpful for you to have somewhere to put all those variables, on paper, you can feel free to, save it out of the chat, and we can send it along after this with the other materials as well. But gives you a little place to brainstorm and take those things out of your head and put them down in writing so that you can look at them with someone else. Sunshine, you're saying it's hard to get folks to slow down and fight a sense of urgency. Absolutely, that's the time horizon is often a huge motivator for decisions, and often it's the ones that are urgent that get the most priority. But Michelle is saying those factors mostly summarize the criteria organization considers. Yeah. And I think they're ones that we highlight because they tend to be relevant for lots of organizations. I think some that we also sometimes see are things around, you know, in addition to how aligned is this with our mission, is there something about this decision that would make our work more equitable in our community? That can be a really great one to add to this. That we definitely see a lot of organizations feeling really strongly about, because that can be a really critical deciding factor. Yeah, there's lots of ways that values can come into these decisions, and so I think that's really critical. So with that, we have just a little bit left here, and I'm going to go ahead and share my screen one more time, and it should be up now. So, you know, anytime that you're engaging in scenario planning, it's a good idea to work with your core stakeholders, your staff, your board, your funders, your partners, any champions in the community that are going to, you know, be impacted by this decision. Get their input so that you can be sure that you're clear on the implications of any scenario that you're considering. People with different vantage points have really different perspectives on the impact of your work and what it means to carry it out and what it means to your community. And so getting that input can be a really powerful way to ensure that you are making the decision with all of the information that you need to understand what it's going to mean. The next piece here is, you know, we really want to make sure that you're clear on the options that are available to your organization. You may start mapping out various scenarios, and as you go through that work, realize that one is just really not going to be feasible. Be explicit about that with your people if that is something that you find along the way. But also, if you choose a plan and something unexpected happens, then that changes the viability of that scenario. It's time to step back and look at your other options again. It's great to be able to identify an ideal situation, but sometimes the circumstances in the world don't work out as you initially thought they would. And that's a great moment to take time and consider, well, what would we do if you know, that funder actually won't increase its grant? Maybe the answer is going to be spending more time seeking additional grants. Maybe it means, you know, launching an online fundraiser or cutting expenses somewhere in order to make up the difference. Mapping out what you would do if that doesn't happen in advance, it helps you avoid always being in that scramble mode, in that like crisis management. If you can say, like, if this doesn't work out, here is our plan B. Then it's also really important at that moment to be clear on who's going to be responsible for making those kinds of decisions. Finally, if there are milestones along the way or major events that you're going to have to wait for to understand how you're going to best move forward, try to identify as many of those at the onset. One thing that was a huge trigger in the beginning of the pandemic was, you know, are schools going to reopen? When are they going to reopen? What is that going to mean for the work that we do, or how our people are able to, you know, do their work? And, you know, waiting for an approval on a contract that would mean expanding your work into a new school district, waiting to see how long it takes to fill a position that you've got open. All of those can be trigger moments that are going to influence what it means for when you can actually engage in taking forward one of the scenarios that you're considering. What we really want you to come to is the question of, you know, along all of the things that you're weighing in this process, what are the aspects of your mission that you want to ensure that you are preserving regardless of which scenario is playing out? This should be the question that you have at top of mind at every step along the way, and really center in the discussions that you have with your people. So with all of that, we are coming to the end of our time here, and I do want to share a quick resource with you. We are going to turn it back over to Christine for some closing items in just a minute. We do have a tool on our website. If you think that the idea of putting your budget into scenarios sounds like exactly what you're looking for, you don't need to reinvent the wheel because we have it on our website, and you can download it and you can, fill it out. It's an Excel tool. And we even have a video that you can use to just like see how to use it step by step. So we'll share that link with all of you, and feel free to use it at any time. We also have some other free resources available on our website. We've got a whole all of the webinars that we were drawing from today, as well as the other ones Sherr showed at the very beginning. We have a 12-part blog all about budgeting. We've got lots of stuff available on our website, and you, feel free to just dive in whenever you want on any of that. We just want to make sure you know it's available to you. And here we are so glad to have had your participation today. I am going to turn it over to Christine, but just wanted to make sure that you all knew how you can reach us if you have more questions after this. Sherr and my emails are both here. And with that, I'm going to stop sharing my screen.
Thank you so much, Jackie, Sherr, and Emma, working behind the scenes. We know it's really challenging to do this kind of webinar. And, in essence, our nonprofits, I'm really thankful to you too, because you were sort of our guinea pig to try out this new modality. Continue to have these virtual webinars so that they are more accessible and easier to get to than driving through downtown traffic, right? And trying to find parking. But at the same time, we know that it comes with its own challenges. So we really appreciate everybody for sticking around. And I think it's really a testament to the content and the thoughtfulness of the NFF team in putting together the interactive parts and, really trying to make it relevant to, the different situations that our nonprofits are in. By the fact that so many of our nonprofits have actually stuck around. We have most people who did stay the entire 2 hours. So please give a round of applause to Sherr, Emma, and Jackie, as well as to all of you. If I can just have a little bit more of everyone's time, I have just a few announcements that I wanted to